Last week, I ended with 3 words: they'll learn faster. I said the institutions that pull away from the competition over the next decade probably won't be the ones with the newest technology. They'll be the ones that get better faster. And today I want to explain what I mean by that. Hi, everyone. Welcome back to Next Move Banking. I'm Virginia Heyburn, Principal Strategist with Engage FI. If banks stop competing primarily through infrastructure, what do they compete through? Because I think that's where the real story begins. Today, I want to talk about this shift from a system of record to a system of intelligence and why I think it changes where the value comes from. A system of record does exactly what the name suggests. It keeps track of what happened. It posts transactions, it maintains balances, it closes the books, it produces reports. Every institution needs one. Not going away, super important for a financial institution's operations. But if we're honest, nobody has ever switched financial institutions because one bank had a marginally better system of record. Customers don't experience the ledger, they experience decisions. They experience responsiveness and outcomes. And that's why I think we're starting to see something different emerge. Not because systems of intelligence are a new category of software, because they change where value comes from. And let me make this concrete. Think about your best commercial lender, the one who's been in the market for 20 years. They know which businesses are expanding before the numbers even show it. They know which owners are thinking about retirement. They know which borrowers are struggling long before a covenant gets tripped. That's valuable knowledge. But here's the uncomfortable question. Does the institution know it? Or does one employee know it? Because those are not the same thing. And I think that's where this conversation gets really interesting. For years, community institutions have said their advantage is relationships. I think that's only half true. Relationships are not the advantage. Institutionalized relationships are the advantage. If the knowledge leaves when the employee leaves, then the institution never captured the value in the first place. When I talk about learning, this is what I mean. Not artificial general intelligence, not robots running the bank, but the ability to take what your people learn every single day and make the institution smarter tomorrow than it was today. That's learning. And community institutions should care deeply about it because relationship banking only compounds if the institution captures the relationship. For decades, community institutions competed using advantages that were relatively easy to understand. Local reputation, long-standing customer relationships, market presence, of course, the deposit base, those things important, they still matter, will matter. But the question isn't just what advantages you have. The question is whether those advantages are making the institution better over time, because increasingly a lot of the technology that used to be available only to the largest institutions isn't really exclusive anymore. You can buy capabilities today that used to require enormous internal teams to build, which means that the question shifts. It's not just who has access to the technology, it's who learns from what they already know. At this point, somebody is usually thinking, well, okay, Virginia, are we just replacing people with algorithms? No, at least not in the way people often imagine. And honestly, I'd be skeptical of anybody who tells you otherwise, because intelligence and governance are not the same thing. A model can learn, a model cannot govern itself. A self-retraining credit model that creates model risk obligations, it still requires validation. It still requires explainability. It requires oversight. For a community institution with a small risk team, that is not a footnote. That's real work, which is why I don't think the answer is to automate everything. I think the answer is to start where the governance burden is lowest and the payoff is easiest to see. So some of the areas that I'm thinking about are fraud detection, deposit attrition, operational resilience, and of course, customer retention. So build the muscle before you try to automate the most heavily regulated decisions in the institution. Self-optimizing? Yes, absolutely. Is it self-governing? Never. The guardrails still belong to you, and regulators will expect nothing less. Now, let's talk about why any of this matters. Imagine 2 institutions. They're the same size, in the same market, they have the same products, same starting point. One improves primarily through periodic projects, and the other improves continuously. It's not dramatic. It's not magical. It's just continuously a little bit better every day. A slightly better fraud model, a slightly better retention strategy, slightly better pricing decisions, slightly better operational process. It all compounds. It's not making headlines on the daily, nothing that changes the world in those small steps, but over time, those improvements start stacking on top of each other. One institution learns from every interaction. The other learns from every project. 3 years later, they may still look similar from the outside, but inside they're operating on completely different trajectories. And the dangerous part is that financial institutions often don't notice that gap forming until it's already significant. Community institutions often assume they're losing a tech race, and I don't think that's the right way to look at it. You're not going to outspend a megabank. You're not going to out-engineer a megabank. You're not going to outdata a megabank, but that doesn't mean you can't outperform one. The question is where? Community institutions have always had access to context that the large institutions struggle to capture. The challenge is that most of that context still lives in conversations. It lives in emails and lender notes in people's heads, and it's not becoming institutional knowledge, which means it can't compound. That's the opportunity. Not collecting more data, it's capturing more insight in the areas of the financial institution, in the areas of the offerings that you provide that really matter most, that provide the most amount of competitive distinction for you. Because if your relationship advantage only exists inside a lender's head, it doesn't compound. It can't be shared. It's not institutionalized. If it becomes part of how the institution learns, then it does. So if I were sitting in a board meeting tomorrow, I would not start by asking about AI. AI, for the sake of AI, is not going to go anywhere. I would ask something much simpler. Are we getting better at serving customers? Are we doing a better job pricing risk? How are we doing retaining deposits? And what's our decision-making process like? How can we make it better? Where are the weaknesses? How would we even know if we got better at it? Or conceivably worse? We have to be able to measure it, because if we can't answer those questions, then the technology discussion is happening too early. The challenge is not keeping up with technology. The challenge is building an institution that gets better while it's doing the work. And once you start thinking about it that way, the next question is really clear. If relationships are still the advantage, and I think they are, how do you keep that advantage from walking out the door every time someone retires? How do you turn relationship knowledge into institutional knowledge? Because that's where data enters the story, not as a technology project, as the raw material that allows the institution to learn. And that's what we're talking about next week. I'm Virginia Heyburn, and that's your next move.